Alright, people, for your first assignment, the second question is about working on an Excel file named Chapter 3. You can download this file from the Canvas, and you can see in this module, financial statements and the ratios. This Excel file is there. You can also find it under the files of the Canvas and just to check all the inventories of files. So this is the Excel file when I opened up for Chapter 3. So your job is to fill in the formulas for these financial ratios colored in red. So just like this. Now they are just simple numbers. As you can see from the formula bar, there are no Excel formulas, but just numbers. So what I want you guys to know is to do the calculation using Excel. From the previous exercise in Excel Chapter 2, we learned this technique. By creating a new window, we can work on the same file with two windows, one for the working window and another is for the reference window. And I hope you guys still remember that. So first, create a new window, and then hit View again, arrange all vertical. So this is how we see them. On the left-hand side, I want it to be the working window, and the right-hand side, I want it to be the reference window from where I borrow the numbers from the balance sheets or income statement. And also, I need to shrink my head a little bit so it does not block your view. Okay, so this is the setting I want to start the work. So the first ratio you need to calculate is a current ratio, and that's one of the liquidity ratios. And by the way, liquidity ratios measures the firm's short-term ability to pay off its short-term obligations, and it is the current assets over current liabilities. So if you check the balance sheet on the right, then you'll see the current assets is right here. Okay, it's a 1550 divided by the current liabilities. It's right here, 780. So just to check the two cells I selected. And then I hit enter. You will see the number output is still 2.0, but there is a formula built in there. And once again, just like your first Excel project, to do this one, your grade is solely based on the formulas. All right, so your grade is based on formulas. That's fairly important. If you give me a file with no formulas, just like the way it is given to you, then you don't receive any points. All right, so after we have done the current ratio for 2016, I just drag it by one cell to the right. Then the same formula is duplicated for the different column numbers. The next one is quick ratio. And a quick ratio is your current assets excluding inventories, because inventory is not quick when converted to cash. So that is the numerator of the ratio and divided by the current liabilities. All right, and then drag it to the right. So this is the first group of ratios. It's called liquidity ratios. And then for assets management ratio or the efficiency ratio, the first one we calculate is sales. So and the sales come from the income statement. So I will need to scroll down the reference cell and find the net sales there divided by the total assets, which is right here. Okay, and then drag it all the way to the right. And the fixed assets ratio here, sorry, I'm going to use the sales divided by the assets, the fixed assets. All right, and the next one is called a day sales outstanding ratio, where you're gonna use 365 days in a year divided by the receivable turnover. And receivable turnover tells you how many times is your receivable get collected from the time it is outstanding during the year. So, and you use the number of days in a year divided by that divided by the times is telling, and that's telling you how many days that it take on average to collect your receivable just once. So how do you get your account receivable? You're gonna use sales, it's right here, divided by the accounts receivable. And be careful, you will need to sales account receivable. So be careful when you do the input. You need to put a set of parentheses to prioritize the calculation of a receivable turnover. And then after 2015 is done, you drag it to the right to get the calculation for 2015. As you can see, the formula is replicated. And the inventory turnover ratio, it is the cost goods sold divided by inventories. So the cost goods sold is right here, divided by, I see it's right here, divided by inventories. Okay, and the inventories is related with the raw materials, so that's connected to cost goods sold. If the inventory is about a final product, then the numerator you should use would be sales. The next category of ratios is the debt management ratios. First and foremost, you guys should know that debt incurs interest. So if you check the company's liabilities, so these are the major items. Only notes and bonds incurs interest expense, whereas accounts payable and accruals are just unpaid bills. The amount does not change over time. However, for notes and bonds, you not only pay the principal but also the interest. With that being said, let's work on the first ratio, the total debt ratio. So which is total debt divided by the total assets. So the total debt, as I said, includes two components. One is short-term notes and another is long-term bonds. So make sure I select them in the right row and then divided by the total assets. Nice and easy. See, the number is completely the same as the given one, but I have a built-in formula behind it. The next one is debt to equity ratios. I'm going to perform the same old trick again, include both notes and bonds in my calculation of a total debt. This time I'm going to use it to divide the total equity. And then the next one is called a market debt ratio. It is this ratio is different from the total debt ratio because the denominator has changed to total debt plus the market capitalization. So CAP stands for capitalization, which is the stock price multiplied by the shares outstanding, or the market value of the equity. In the previous total debt ratio, total assets include total debt, total liabilities, plus the book value of the equity. But here we replace it with the market value of the equity. All right. So again, include both notes and bonds as total debt divided by total debt, notes plus bond. And then this time I'm going to insert the market value, which is the stock price per share multiplied by the number of shares outstanding. So here is my formula. If you're not sure what to input, here is the formula bar you can follow. Okay, drag it. Then the next one is total liabilities to assets ratio. So this is the easiest. I will just scroll it down the reference window and check the total liabilities. It's right here. Use it to be divided by the total assets. And then nice and easy. The next one is the time interest earned ratio, or the TIE ratio. I will need to use the items from the income statements, starting with the EBIT, or the operating income. So that's 500 here, divided by the interest. And this ratio measures the firm's ability to pay back its debt. So we want to have a sufficient operating income here, while the interest is limited. All right. The next one is a beta coverage ratio, which is a little upgraded version from the TIE ratio. in the numerator, you add back the depreciation to recoup the cash effect. You also have the involvement of a lease payment, which occurred on a regular basis. And down the denominator, not only you pay interest, but also part of the principal plus lease. The information, parts of information is given on the top. You have the lease payments, and the principal would be the required sinking fund payments, which is the portion of your payment that is going toward paying back principals. Okay, so again, I will get to my EBIT from my income statement. It's right here, plus the depreciation, which is above it, plus the payment for lease, okay, which is 28. And then down the denominator, I will use the interest plus principal amount and a lease payment. Okay, lease payments here, principal amount is here. So 3 components, as you can see, 1, 2, 3 down the denominator, and here is on the formula bar. All right, then drag it to the right. So here we got the formulas. All right, the next category is a profitability ratio. It is also easy to do, and it's also easy to comprehend. You see, the first one is a net profit margin. I should say there's a word net added. There should be a word net added in here. So the net profit margin is the net income divided by the net sales. So let me use the net income, which is right here, divided by the net sales. So this is my number, 4.4%. Then I drag it to the right. And the basic earning power is your operating income divided by the total assets. All right, then drag it. Of course, for all these profitability ratios, we want them to be as high as possible. And return on assets, once again, I'm going to use the net income at the bottom of my income statement divided by the total assets. Here's my percentage. And for return on common equity, I will use net income again divided by the total common equity. Okay. So the next category is the market value ratio, which you have to use the stock price. And that's a different system because the stock price is available in the open market, which is subject to change by the buyers and the sellers trades, and the frequency of the trades could be hundreds of nanoseconds, which is millionths of seconds. So this is a different system compared to the book value system, where you find the financial statements on the company's annual or quarterly releases. So the first one is price-earning ratio, and you should know that price-earning ratio, the numerator is the price, and the denominator is the earnings per share. So let me first put the numerator stock price is given as $27 now, divided by the earnings per shares, and the earnings per share, the earnings in total is the net income, which is 220 right here, divided by the number of shares. You have a 50 million shares. I mean, everything is in millions, so just say 50 shares. So that's your earnings per share in the parentheses. Then you hit enter, and then drag to the right. The next one is a price to a cash flow ratio. The only thing changed from the previous one is for the numerator of the earnings per share, you add back depreciation. So in the previous chapter, we learned if you add depreciation back to net income, you recoup the non-cash effect from the depreciation. So it's all canceled out. So the numerator here, net income plus depreciation, is a 100% pure cash term. So right here, again, I will use a price divided by, this time is a cash flow instead of earnings, which I will use the I will use the net income plus and be careful, you can't just hit enter yet, it's not completed. You have to put another set of parentheses here to prioritize the calculation of the cash flow ratios. So this is how it's supposed to be written. Two sets of parentheses. One is for the cash flow and another is for the cash flow ratio. Okay, the next one is price to EBITDA ratio. EBITDA stands for earning before interest, taxes, and depreciation, amortization. So this time, again, I will use the price divided by the EBITDA ratio. So in the EBITDA ratio, you need to, again, have two sets of parentheses. The inside parentheses should include the EBITDA, which is EBIT from the income statements, plus the depreciation. All right, and then the whole thing will be divided by the number of shares on the top. It's given here, and then close the parentheses. Then drag it to the right. Okay, the next one is a market to book ratio. It is the price divided by, well, if I extend it, it's the total common equity divided by the number of shares. The thing is that parenthesis is the book value of equity at a per share level. Okay, and the same book to market ratio could be expressed at the cumulative company level. So you see a price times number of shares. That's what? That's the market value of the firm. That's very important concept in the financial world. Price times shares is the market value of the firm. We can also call it market capitalization. And then the total common equity is the book value of the firm for the shareholders. Okay. With that being said, you guys should know the outcome should be the same for the two. One is at the per share level and another is at the company level. The market to book ratio here at the per share level is the stock price. I'm gonna use the stock price up here in the reference window, divided by the book value per share, and the book value would be the total common equity, which is on the balance sheet. It's right here. Okay, don't forget to use the parentheses, and then divide the book value per share using the number of shares outstanding. Okay, so that's my number. And if I calculate the M to B ratio in the firm level, then I will first need to get the market value of the firm, which is the stock price multiplied by the number of shares, and the whole thing will be divided by the total book value at the cumulative level, so which is the common equity. All right, and then just to drag it. Okay, so now I have finished calculating all the 5 categories of financial ratios, all the way from liquidity ratios to asset management ratios to debt management ratios, and then profitability and then market value ratios. What is required out of you is not only to calculate all the ratios based on the data, and I'm not worried about that because you always get access to the formulas. What I really want you to know is whether it is good or bad when the ratio changes. So basically, if we want the ratio to be better or good, so we want a high current ratio, but not extremely high, because if you hold too much cash or too much current assets, you are not using it just to put it in your inventory or in your pocket, you have some opportunity cost. So, but in general, we want them to be sufficiently high. And the quick ratio, we want it to be high, so it's good. And for assets turnover, we want this to be high. We want this to be high for both of them. And for day sales outstanding ratio, well, that is the number of days to either collect your bill or liquidate your inventory, sell your final products. And we want them to be low. We want to take shorter time to collect our bills to sell our products. And the turnover, we want them to be high because within the same year we want them to have replace our inventories as many times as possible. The best case is to have an infinite amount of sales, whereas the inventory is quite limited. And for the debt ratio, well, as I said earlier, that too much debt would indicate financial distress. So we want them to be low, okay? And all of this, a low debt ratio would be preferable. And for this TIE ratio, in times interest earned ratio, we want it to be high because we want a sufficient operating income represented by this EBIT, and we want the interest expense to be limited. And likewise, for this EBITDA coverage ratio, we want it to be high. And for all these profitability ratios, we want them to be high, so that's pretty straightforward. And for the market value ratios, well, the thing is, if a market value ratio is high, that just indicates the stock is expensive. So we value the stock value based on the earning generating abilities of the company. So if the firm still have the same earning per share, but the price is super high, so that's definitely a overpriced stock. And then likewise, we can only conclude that this stock price is expensive. Should you buy it? Probably not. If you hold the stock, should you sell it? Probably yes. Okay. All right, and then we move down to the other parts of the financial analysis after we calculated all the ratios, and we are going to compare the company's own ratio represented in this column. And the key feature here is return on equity. As I said, that's what the shareholders or the owners care out most. That's the return on equity, which is net income divided by total equity. And we compare the company's ratio against the industry average to see whether the firm outperform or underperform the industry. There are not too many questions I could ask out of here, but you should know that's what the ratio is used for. You can either use the industry as a benchmark or just to compare with your historical data. And here is a chart generated by your textbook. So actually it's in your textbook generated by the book provider. So you will see the company's ROE has this trend, and the industry has another type of trend. It's just growing steadily up, but the company's ROE is not. To generate a chart like this is actually pretty easy. You just select all the data here. You insert a line chart. Okay, and then you just input the names of the chart and the names of the axis, and that's it. So there's nothing too much to require here. And the next thing you want to do some work on is a common size analysis. The common size financial statements, like right here, is the income statement. Take away the size effects. As I said, some companies are operating in billions of dollars, and some are only operating in thousands of dollars. And we can only get the information if we know the percentage. Because for some companies, even though they have millions of sales, but in terms of percentage, it's not that good. So if you want to calculate this this percentage, so your base for the income statement items would be the net sales. So what I'm going to do here, again, I will click the window for reference. All right, this is my window for reference, and for this window, I'm going to zoom it out a little bit. Okay, so I will move down to the income statement, and I will use the arrange all vertical, and I will use the net sales as the common denominator, which is right here. Okay, and then for the sales in common size, I use it to divide by itself. If I drag it down, then everything here would be 100% because I did not quite use the net sales as a common denominator. So before I drag it down, let me just undo it. Before I drag it down, I want to lock this denominator of a net sales. So how do I lock it? You can click the hotkey F4 on your keyboard, or you just manually undo it. Just manually input the $sign before the column letter and the row number. All right, and then you can just drag it down, and you can see all the percentages are calculated. And you're gonna do the same thing for the other year. You use the net sales divided by itself. Since you are going to drag it down, you want to make sure all the other numbers are using the same denominator. So you're gonna lock the denominators here and then drag it all the way down. And you can also delete all these underlines because that doesn't look very good. So you will see the borders function here. So you just first clean them all, no border, and then you can just add your own border here at the proper place. Okay. Okay. So this is your common size income statement. And if you look at the common size balance sheet, again, you have all these percentages, and your total assets would be the base here, and the total liabilities and equity would be the base here. So I'm going to pull out my reference window again, and this time I'm going to move up to the balance sheet. So for all the items here, I'm going to use the item divided by the total assets and make sure the total assets is locked. All right. And then drag it to the right and then move it all the way down. And likewise for the liabilities and equity, I will use each item divided by the total and make sure the denominator is locked. Drag it all the way down. And then again, I will edit the format a little bit. Okay, just to put the border in the right place. Just bear with me. And you're gonna do the same thing in your assignment, so I don't really feel bad. It's not really a wasting of time. Okay. The next subject is DuPont analysis. So the DuPont analysis basically breaks down the ROE into three components. One is a profitability ratio called net profit margin, and another is efficiency ratio called a total assets turnover, and here is equity multiplier, which is a debt ratio. Okay, so the ROE here is a product of three different ratios. So first, let's get the net profit margin ratio. Well, it is a given. We have already calculated it before, remember? It is right here, 4.4%. So we just use the link to connect the reference cell. And the assets turnover ratio is also calculated already. So this time I will use this reference window. So the assets turnover ratio is right here. Okay, if you cannot see it very clearly, you will see a number equals to 1.4 here. That's your assets turnover ratio. And for equity multiplier, that number is not quite given. You need to calculate it, but don't worry, that's pretty easy to do. You just need to use your total assets divided by the total equity. So I will move it up. You see the total assets is in the statement, is in the balance sheet divided by the total equity, which is down there. Total common equity is right here. All right, and I have calculated all the three ratios based on the formulas, and the ROE basically is the product of all the three cells. Just use it equals to all three of them. Okay, you can check the formula bar here to see the result. And for the rest of it, I'm not gonna do it here, but you will do it by yourself. It's just the same ratios for a different year and just calculate it by yourself. Okay.